What if I told you there's a market out there bigger than stocks, bigger than crypto, and more powerful than any other financial force you can imagine? A market so influential that it decides the fate of your mortgage, your job security, the money in your retirement account, and even the price of your favorite tech stocks. Here's the kicker. Most people, even people who are investing every month, barely understand how this market works. And if you don't understand it, you honestly don't understand how money works at all. Stick with me to the very end, because once you truly get bonds, yes, boring old bonds, you unlock the real rules of the financial game. And you'll see opportunities where everyone else sees confusion. Hey, what's up? I'm your buddy investor. If you're new here, welcome. My mission is to help you escape financial confusion and reach real financial independence step by step with simple, practical strategies. No hype, no complicated jargon, just real talk so you can build wealth and actually sleep at night. I've spent years learning from the world's best investors, and my goal is to be the friend I wish I'd had when I started out. If you want to take control of your money, avoid all the rookie mistakes, and finally get on a path to financial freedom, hit that subscribe button. Seriously, it's one tiny click for you, but it makes a world of difference in keeping you motivated, connected, and ahead of the curve. Let's dive into why bonds are the hidden lever of the entire financial system, and why understanding them is the closest thing to holding the cheat codes to money itself. So first things first, what is a bond really? Let's keep it dead simple. Imagine you're starting your dream business. You've got the energy, the plan, the hustle, but you don't have the cash. So you go to someone with money and ask for a loan. In return, you promise, "I'll pay you back, plus a little extra for your trouble." That little extra is interest, the cost of borrowing someone else's money. Now, think bigger. Governments do this too. Big corporations do this. Every time they need to raise money and can't just print it or sell more stock, they issue a bond. A bond is just an IOU, a contract that says, you give me your money now, I'll pay you interest every year, and then I'll give you all your money back at the end. Simple. But here's where it gets interesting. Bonds are the backbone of the global economy. There's over $100 trillion in the global bond market. That's trillion with a T. For perspective, the entire global stock market is around half that. The bond market is where countries, companies, and even cities go to fund their plans. Let's break it down. When you buy a bond, you're lending money. If you buy a US government bond, you're lending money to the US government. If you buy a corporate bond, you're lending to a company. The bond spells out a few key things: the principal, the amount you're lending, the coupon, the interest you'll be paid, the maturity date, when you'll get your money back, and the yield, the real return you get based on the current price of the bond. So why does any of this matter to you? Because every single thing in your financial life, from your mortgage rate to the value of your investments, hinges on what's happening in the bond market. Here's a wild story. Warren Buffett, one of the richest investors of all time, actually started out in bonds. Before he was the Oracle of Omaha, he spent his afternoons as a kid reading Moody's manuals, basically giant encyclopedias of bonds and stocks. He learned early that understanding bonds meant understanding the real cost of money, risk, and reward. Buffett has said that bonds taught him how to spot a good deal, and more importantly, how to avoid a bad one. Let's make this practical. Imagine you have $1,000 to invest. You can lend it to the government and earn a steady interest payment. Safe and simple. Or you can buy stocks and hope for bigger gains, but with more ups and downs. The yield on government bonds, the so-called risk-free rate, becomes the benchmark for everything else. If government bonds are paying 5%, suddenly, stocks need to deliver even more to justify the extra risk. If they can't, investors might start selling their stocks and moving their money into bonds instead. That's why when the bond market sneezes, the stock market catches a cold. Let's look at a real-life example. Remember when mortgage rates shot up in 2022 and 2023? That's not random. That's because yields on government bonds spiked, making it more expensive for banks to borrow, and so they raised rates on everyone else. Suddenly, buying a home was way pricier, which slowed down the housing market and even caused some home prices to drop. Here's another thing. The US government is always spending more than it takes in. That's called a budget deficit. Every year we run a deficit, the national debt grows. And how does the government fill that gap? You guessed it, by issuing more bonds. When investors snap up those bonds, the government can keep running. When they don't, well, things get messy. But why do investors around the world, from pension funds to foreign governments, love US bonds? US Treasury bonds are considered the safest investment on earth because the US government has never defaulted. For now, if you lend money to the government, you're almost guaranteed to get it back, with interest. Now, let's break down some bond terms in plain English so you can actually use this in your own life. Principal, the amount you're lending or investing. Coupon, the interest payment you receive, usually once or twice a year. Maturity, the date when you'll get your principal back. Yield, your actual return, which can change if you buy the bond at a different price. Here's where it gets a little tricky, but stick with me. Bond prices and yields move in opposite directions. If new bonds are being issued at higher interest rates, the old bonds with lower rates become less valuable. So their prices fall and their yields go up. If rates go down, the opposite happens. It's like trying to sell last year's smartphone when a new, fancier one comes out. You have to lower your price to compete. So how are these rates set? The government holds regular auctions, offering new bonds to the highest bidder. The interest rate they have to offer depends on how much demand there is. Lots of buyers mean the government can pay a lower rate. Fewer buyers? They have to pay more to attract investors. This is called the primary market. But after that, bonds trade all the time between investors. That's the secondary market, where prices rise and fall based on what people think is going to happen with the economy, inflation, or interest rates. Let's zoom out. Right now, the US has over $36 trillion in national debt. That's a mind-bending number. But what matters most is the debt to GDP ratio. That's like comparing your credit card balance to your annual salary. The higher the ratio, the more dangerous the situation gets, especially if interest rates go up. And here's the thing. A lot of the government's debt is in short-term bonds, which have to be paid back or rolled over every few months. If rates shoot up, the government has to pay a lot more in interest, which eats into money that could have gone to schools, hospitals, or even tax cuts. Let's bring it back to you. The same thing happens on a smaller scale in your own life. If you're constantly refinancing your debt, like rolling over credit cards or taking out new car loans, rising rates mean higher payments and less room in your budget. That's why understanding bonds isn't just about Wall Street, it's about your everyday money decisions. So what happens when bond yields spike? Government bonds start looking really attractive compared to stocks. Think about it. Would you rather earn a guaranteed 5% from the government or risk it all for maybe 6% or 7% in the stock market? As that difference shrinks, people start selling stocks and buying bonds, which can make stock prices fall. That difference is called the equity risk premium, and it's a huge deal in deciding where big money flows. There's another piece to this puzzle. Not all bonds are created equal. US Treasuries are super safe, but corporate bonds, loans to companies, carry more risk. If a company runs into trouble, you might not get your money back. The difference between what safe government bonds pay and what riskier corporate bonds pay is called the high-yield spread. When investors get nervous, that spread gets bigger. It's like the canary in the coal mine for financial trouble. Want to see the future? Watch the yield curve. Normally, long-term bonds pay more interest than short-term bonds because locking up your money for longer deserves a higher reward. But sometimes the opposite happens. Short-term yields go higher than long-term yields. That's called an inverted yield curve, and it's one of the most reliable warning signs of a coming recession. Every major recession in modern history has been preceded by an inverted yield curve. Let me share a story from the 2008 financial crisis. Back then, the yield curve inverted well before the crash. The bond market was trying to tell everyone something was seriously wrong. But most people ignored it because they didn't understand how bonds talk. The few who listened, like hedge fund manager Jeffrey Gundlach, who is known as the Bond King, made fortunes while everyone else got crushed. Now, don't worry, you don't need to become a bond trader to use this knowledge. You just need to understand how it affects your money. Here are some practical, step-by-step ways to use bonds in your own investing strategy. Start with treasuries if you're new. US Treasury bonds and Treasury bills are as close to risk-free as it gets. You can buy them directly from the government at treasurydirect.gov or through your brokerage account. Mix bonds with stocks for stability. Bonds help smooth out the wild swings in the stock market. Even legendary investors like Ray Dalio and Jack Bogle recommend having some bonds in your portfolio, especially as you get closer to big goals like buying a home or retiring. Consider bond ETFs for simplicity. If you don't want to pick individual bonds, look at low-cost bond ETFs. These are funds that hold a big basket of bonds and pay you regular interest. Examples include AGG or BND for broad US bonds and IEF or TLT for longer-term treasuries. Keep an eye on interest rates. When rates are low, long-term bonds might look tempting, but if rates rise, their value can drop fast. When rates are high, locking in some longer-term bonds can make sense. Don't chase yield blindly. High yields can mean high risk, especially with corporate or junk bonds. If it looks too good to be true, it probably is. Let's make this even more actionable. If you want to go deeper, read The Bond Book by Annette Thau. It's hands down the best guide for beginners and will make you way smarter than 99% of investors. Another classic is Common Sense on Mutual Funds by John Bogle. There's a great section on bonds that's easy to follow and full of practical tips. Now, you might be wondering, okay, but can bonds actually help me get rich, or are they just for old people? Here's the truth. Most people who actually build serious wealth use bonds as part of their strategy, not for explosive growth, but for staying rich. As Warren Buffett says, the first rule of investing is never lose money. The second rule is never forget the first rule. Bonds help you follow both. Let me tell you about my friend Lucas. Lucas started investing right out of college, just $100 a month. He put most of it into index funds, but he always kept about 20% in a simple US bond ETF. When the stock market dropped 30% in 2020, Lucas didn't panic. His bonds held steady, and he was able to buy more stocks at low prices using the interest payments from his bonds. Fast forward 5 years, and he's well on his way to financial independence, not because he chased crazy returns, but because he understood how to balance risk and reward. But here's where it gets really interesting. The bond market is like the mood ring of the economy. If you pay attention to what's happening with yields, you can often predict where the economy is headed, sometimes before the headlines hit. This is what the pros watch. But now, you have the same information in your toolkit. Before we wrap up, let me remind you, if you're serious about building real wealth and freedom, subscribe right now. This is how you stay connected with everything you need to reach your goals faster, avoid costly mistakes, and take advantage of opportunities while others are left guessing. And if you're thinking, okay, I get it, bonds matter, but I have no idea where to actually start with investing right now, then you do not want to miss my next video. If I started investing today, this is what I'd do. I'll break down exactly how I'd invest my very first dollar, with all the tools and strategies I wish I'd known from day one. Thanks for hanging out with me, your buddy investor. Remember, understanding bonds means understanding money. And understanding money means you're already ahead of 99% of people out there. See you in the next one.